All right, well, we'll go ahead and get started. If at any point anyone has questions, there's a chat feature. Feel free to throw questions into the chat. Troy will be making sure we keep an eye on it. To be honest, we almost never get questions. I like to think that people have questions. If the chat just doesn't feel like the right place for them, never hesitate to just follow up with us after the fact. The reason that we have these presentations is that we just wanted to spark some dialogue. So anything here, a lot of it is general. All of you are perfectly individual people, everyone with their own circumstances. So if anything here generates any questions, please don't hesitate to reach out to us directly if it seems like asking a question through the chat isn't quite the right way to go. For today, following a similar format to what we like to do, we're going to look backwards a little bit for about the first third of the presentation. We're going to look at equity and fixed income markets, how they did in the fourth quarter, as well as zooming out just a little bit for calendar year 2023. We'll look at the investment themes for equities, the investment themes for fixed income. And we're going to talk a little bit for both markets about market concentration. We're going to talk about valuations. Lately, it's been very hard to not talk about the economy as well. So we're going to have an economic update. Tends to be every quarter for the past 2 years, very similar things that we talk about here, but trends for inflation, trends for interest rates, and then ultimately what the questions we get and what everyone wants to know is those trends and data, what do they mean for recession? Are we going to have a recession? Are we not going to have a recession? We'll talk about how all of that fits together. And then lastly, we always like to conclude our presentation with talking about implications for investors and the portfolio management considerations for all of the data that we discuss. We keep an eye on a lot of data, we monitor things, we evaluate, but when all is said and done, it's just what do we do with that information? How does that actually impact investors? What can you actually do to respond or prepare for any of these market conditions through the portfolio management process? And so as always, we will close out our presentation with the implications for investors. Before we ever talk about market data or what they've done or what they might do in the future, we always like to have a refresher on our investment philosophy because we don't make changes quickly or lightly or without a lot of thought. So all this data that we talk about is just something that we monitor. It's not going to be lead to a drastic change of what we do next. But our investment philosophy is a disciplined approach regardless of market conditions. We like research-driven. We like grounded in academia. It is a globally diversified portfolio while remaining an aspect of cost consciousness. Goals-based, we start everyone that we manage money for with a financial plan. It's all about determining those goals. That's why we manage money, is to help people fulfill their goals. Goals-based to engineer your portfolio's long-term success. And then we operate off of a dual risk mandate, which means that we look at not only willingness to take risk, or what's traditionally referred to as risk tolerance, but also the ability to take risk. Again, tied back to the financial plans that we complete for our clients. All right, so for the short-term aspect, the fourth quarter had a really, really great close to 2023. To be honest, doing these presentations is actually always a lot easier when markets are good. Part of it is harder because it makes it a little harder to feel like we have stuff to talk about. There's nothing to explain. There's nothing to convince anyone of. It's just talking about how good markets have been. It doesn't even make it a little bit easier. But U.S. stock market was up a little bit over 12% in the fourth quarter. Followed shortly behind by developed international stocks, which has been a trend for quite some time, with international developed underperforming our U.S. stock market. Emerging markets lagging a little further behind, but finally seeing some turnaround that we had seen on a lagged effect for them overall. Even global real estate for the last 2 years has been one of the more difficult asset classes. We're going to spend a lot of time talking about interest rates. Real estate is very impacted by interest rates, just like bonds might be. Moving on to our next asset classes for our bonds. Great quarter for U.S. bond market. In fact, it wasn't just a great quarter, it was the best quarter. U.S. bond market was up just under 7%, 6.82% for the quarter, which was the single best quarter in history for the US bond market. Same thing for global bonds as well. It's only just about 2 years from the single worst quarter that we had ever had in bonds, which was the first quarter of 2022. So just from a short-term snapshot, we had a really great quarter in the fourth quarter of last year. Zooming that out a little bit, overall it was just a really great year. U.S. stocks were up just under 26%, similar to the quarter. International developed was up 18, lagged just behind the U.S. stock market. Emerging market stocks were up 10%, again lagging just behind developed international. And then for our U.S. bond market and our global bonds, up 5.5%, up 8.32% for the year. Looking back further from a 5-year perspective, from a 10-year perspective, for us, what stands out considerably is that U.S. stocks in particular, even with in a 10-year period, effectively 3 bear markets. So 2020 markets were down 33% in 3 weeks. Throughout the course of 2022, at its worst, we were down about 25% for U.S. stock markets. And then what we call kind of a half, if not 3/4 bear market at the end of 2018, when markets were down 19.5% instead of the official 20%. For even 3 of those instances in effectively a 10-year period, we've seen great above trend growth for the U.S. stock market in particular. On average, U.S. stocks, we can expect them to return about 10%. From a 5-year perspective, it's just absolutely crushing that average. And then from a 10-year perspective, to still be trading 1.5% per year annualized above that long-term average is pretty impressive. A little bit more of a deep dive into equity markets. The general that we'll talk about historically was just a great year. Looking past the top line of it all, it's still very much a story of mega cap tech companies. What we used to call FANG, what now they like to call the Magnificent Seven, to give it an even more interesting name. Mega cap tech versus everything else. A lot of publicly traded companies in the U.S., many of which are not the Magnificent Seven. So taking it further, we're going to look beneath the surface of more than just what the top line numbers are showing us. And then one thing that was very nice is a break from 2022. Our low volatility trend continued. Every single quarter last year, we talked about, hey, it's been a pretty low volatile year. It's been a low volatile year. And even through the fourth quarter for the entire year, that persisted for us. Looking at how good of a year was it for U.S. stocks? It was just objectively a great year. When we look at the breakdown here of the last 98 observed years, it includes the Great Depression. 73% of the time, U.S. stock market returns are non-negative. So they fall in either, they're 0, they're less than 1, or any positive returns. 73% of the time, returns are non-negative. We can see in our data here that there's a skew exists. If we look at greater than 20% return calendar years and less than 20% down years, 20% down or more, we see quite a bit of skew. About 6% of the time, stocks are down 20% or more, and 37% of the time, with some rounding, stocks are up 20% or more. And what this tells us is that, just staying in our seat as equity investors has an advantage. It's very difficult to know when these years are going to pop up. It's difficult to know when these years are going to pop up, the greater than 20%. We just happen to know they happen more likely, but we just want to make sure that we're staying in our seat as equity investors. We want to participate in markets, whether they're up or down, because we know that by participating, more often than not, it is going to be good years than it is going to be bad. But it's very, very difficult to try and predict next year or this year or 3 years from now, what's it going to be, a up year or a down year. We just want to stay invested because we really don't know. It's hard to predict. So at a very high level, we had an objectively great year. We were over 20% returns in the U.S. stock market. Looking at what were the details that went into last year's returns, there's a few different components. So at the start here, we're going to look at earnings growth. When it comes down to stock prices, market prices, index prices, it's really just a combination of 2 things. It's all of the companies that make up these markets. What are their earnings today? What are their assets today? And the second part of it is, well, what are our expectations for the growth of that in the future? And when we have an expectation of what that growth is, it says, okay, we have a multiple of those earnings that we're willing to pay. All of those two things combined just translate back to what is a price today? What are we willing to pay for those future earnings, for those future cash flows? And looking back on 2023, the earnings growth was a big component of our returns. Surprised a little bit. Earnings growth surprised a little bit to the upside. I think that with rates rising and expectations for finally hitting a recession, overall consensus estimates were starting to sour in companies being able to continue to turn a profit, let alone grow those profits, grow those earnings. So we did see a little bit of a surprise to the upside of companies continuing to grow their earnings. Revenues were the largest contributor to that. So when we look at earnings, there's a top line, there's the revenue, that's the top amount of money that companies are bringing in. We will also like to focus on margins. So after we know companies are bringing in great revenue, how are they managing their expenses in order to keep what comes in the door and translate that into a profit margin? And then there's also a component of share count. Haven't heard about it as much lately, but in the past we've heard of stock buybacks, and is it an issue? Is it a problem? It's been a little bit quiet from a stock buyback perspective for the past couple of years, but that translates to our total earnings per share. And so margins have detracted from earnings. So we already said that revenues were the largest contributor. Companies are selling more, they're bringing more in. Margins detracted from earnings a little bit. Companies were dealing with higher input and labor costs. There was some recovery in this at the end of the year, a lot of it being attributed to efficiency, to digital capabilities. But what we really want to focus on here is, it's good to know where we are today. It's good to know, hey, what was some of the attribution of earnings for the last year? But what we really want to focus on is our expectations, or at least the market's expectations for what earnings will be in the future, looking at 2024, looking at 2025. We don't pretend to suggest that the market is wrong, that we know any better, that we're going to come up with our own earnings expectation that is going to be more accurate. But we do like to be mindful of what these expectations are, because they directly translate into prices today, and it helps us set expectations for all the way on the good, all the way on the bad. What might market returns look like for 2024, 2025? There tends to be volatility in markets when reality and expectations are far apart. Nothing wrong with reality missing expectations, a little bit to the upside, a little bit to the downside. That tends to lead to normal volatility. But whenever we think there's a possibility for wide misses in expectations, that's what leads to the years that you as investors don't like to have. And it's down years in markets, especially when reality is missing to the downside. So we're going to come back to these expectations later on when it comes to implications for investors. But double-digit earnings growth expectations, what the market thinks overall these companies are going to be able to do to expand their earnings in 2024 and 2025, are very much something that we're keeping an eye on, and what kind of impact that's going to have on our markets going ahead. Looking past earnings and focusing a little bit on concentration of markets, general value. Overall, 2023 largely recovered from the previous year's losses. It got us just below tipping back to all-time highs. Since we've turned the calendar, since we've come into 2024, really just in the last week or two, we actually did trickle back into new all-time highs. It's a pretty slim margin. We're about 2% above the previous all-time high for the S&P 500, for example. But 2023 did a really great job of helping us recover from the losses in 2022, now establishing back to a new normal, kind of back equal to previous all-time highs. Overall, outside of just the earnings, a lot of that performance was attributed to better than expected consumer spending, those corporate profits remaining resilient. And then, to me, this is tough to measure, but it's just everywhere, is AI, the enthusiasm, the advancement of AI. There are companies who, as a business, work in AI, but a bigger impact on markets today are all the existing companies that are adopting AI to get more efficient, to be able to serve more people, to be able to expand their business lines. Just the concept of AI is everywhere. We will also talk about that a little bit and the implications for investors. But outside of earnings, from a concentration perspective, and when we say, yeah, hey, the market had a great year, what does that really even mean? What does the market mean? We did see a little bit of a deviation in those Magnificent Seven, those top 10 stocks, what kind of price returns they had for the year and what the rest of the market did. The largest stocks in the index by market cap, those top 10, provided 90% of the market's return last year. The remaining the remaining companies provided 10% of the price return. And so when we're looking at all of those expectations for future earnings, is it expensive to pay what they're worth today? Are they undervalued? We do see quite a discrepancy in those top 10 companies, which we appreciate them for providing most of the index's return in the last year. By continuing to invest in them in the same percentages as we have in the past, we pay quite a bit more as a multiple of earnings, just under 27 times earnings to invest in those companies compared to what the rest of the market costs us right now, which is closer to 17 times earnings. That 17 times earning is very close to a normal, historic, appropriate valuation. Sometimes companies are worth paying a multiple, paying extra for. Maybe that's what the top 10 are. We're still going to invest in them. We're still going to own them, but we're just going to moderate what our allocation is to them and what our concentration is. But as it stands right now, they provided great return for us last year. We're just starting to get a little bit more expensive for them. When we look at implications for investors, that's going to be a big part of it, because those top 10 companies, while they provided 90% of the price returns last year, they are 33% of our index, but provide less than 20% of the earnings. So if we think that the earnings companies produce is important in valuing securities, which we do think that's very important, that's what we're paying for today, is all of their future earnings. The top 10 companies are 33% of our US stock index, but provide less than 20% of the overall earnings. For us, that is a deviation that we think is important, and it's worth keeping an eye on. Internationals. So it's been very difficult to talk about internationals for largely the last 10 plus years. And the reason that it's difficult is because US equities have outperformed internationals so considerably for the last 10 years that it can be really difficult for investors to want to participate in international markets. We ourselves are underweight international. If you look at the entire global, developed stock market, the US makes up about 65% of it now. It's been increasing over time. The rest of the developed world is 35%. If we were purely passive investors, we would have 65% of our stock portfolio in the US and 35% of it in developed internationals. We are underweight developed internationals, but we do think that they are worth keeping an investment in. And what we're looking at here and why we think that's valuable is that if you believe in the value story, which is I very much care about the price I pay for future earnings, the price I pay today for future earnings, and strong balance sheets and disciplined companies and strong cash flows, the value story internationally is much more attractive than it is in the United States. For the same level of earnings, developed international companies trade at a 33% lower price than US companies do right now, which is statistically a two standard deviation event, which means it's about a once in every 25 to 30 year event of that's how far out of the norm it is comparing US prices to international prices. We believe in value. We believe in, well, hey, what's the balance sheet look like? What are those future cash flows look like? How's that going to translate to earnings? And let's pay really good prices for those companies today. And so that's why for us, we're not trying to argue investing more into internationals than the index would suggest or that their market cap would suggest. At this point, it's just our recommendation of don't eliminate them from your portfolio altogether, because we're hearing that quite a lot from DIY investors is, hey, look at the last 10 years of returns in the US, the last 10 years of returns international. Why does international belong in my portfolio at all? Not even just underweight, but why does it belong there at all? And past performance is just no guarantee or indicator of future returns. There's a very good, attractive prices internationally. It's a really good value story. On the right-hand side of our chart here, dividends are considerably higher internationally than they are in the US, about 1.7% higher than we have on US markets. So that's talking close to 4% dividend yield on average for their market, whereas in the US, we have about a 2% dividend yield. So the other thing that we want to be mindful of is that, yes, the US economy is tough to beat. US capitalism is very tough to beat, but don't eliminate international companies from your portfolio. Give international a chance. There's a lot of very good stories there. Again, it's hard to time. You just need to keep it. You just need to keep it in your portfolio. It's not a get in and get out of it type of consideration.
Hey, Nathan, not seeing that chart for the internationals. Just seeing the intro slide. If you could pull that so everyone can see a visual.
Have the slides not been advancing this whole time?
No, yeah, I thought you were doing the intro, yeah. But yeah, there wasn't anything visually that takes away from what you said. So here, though, as you mentioned that chart, if we can pull that up.
Give me a second.
Looks like Rick and Heather can see the slides. Maybe it's just me.
Okay.
That's a good thing.
Rick. Thank you, Rick and Heather. I would have felt really bad talking for the last 20 minutes on slides that nobody saw. So glad it's just you,
Just
Troy.
me. Yeah.
All right. Okay. So looking past international valuations, let me sit back up here. So moving on to fixed income markets. Top line talking points for fixed income, interest rate volatility across all maturities. We've seen some back and forth, which, to be honest, from a yield perspective, is refreshing in 2023 as compared to what we had dealt with most of 2022. And that's because there wasn't really back and forth in 2022. It was just rates rising and prices getting pummeled. So the volatility that we saw, some rates rising, sometimes rates were falling, was actually refreshing, but it makes things a little bit difficult to manage. So there was interest rate volatility across all maturities in 2023. Overall, the market dynamics themselves remain attractive. And then lastly, the Fed you can't remove the Fed from a discussion about fixed income markets. I'll be happy when we have the day. We don't have to talk about the Fed anymore, and we can just get back to business as usual. But as of right now, the discussion is beginning to shift from the Fed and their interest rate hiking as compared to when can we start to expect interest rate cutting from the Fed. So we'll talk a little bit about that as well. Similarly to U.S. stocks, if we put last year within the context of 98 years of reported history, 2023 was an objectively fine year. It was okay. It was perfectly average, 5.5% total return for U.S. bonds, just above the average annual return of 5%. In contrast to stocks, which we saw had a little bit more dispersion, all of those years, 20% returns and above, all of those years, 20% losses or worse. We see considerably less dispersion historically when it comes to the bond market, which is why we like them, which is why bonds belong in a portfolio. They provide us that stability that we need for fulfilling distributions, for rebalancing, whatever it may be. 2022, interestingly enough, if 2022 hadn't happened, the dispersion would have been even tighter because you could see there's only been 1 year where bonds were down 10% or more in any one calendar year. And that year was 2022. Previously, the worst year that bonds had was down really about 3%. Historically outlier year in 2022. So all that to be said, we still aren't disappointed with 5.5% returns in 2023. With a once in a lifetime, once in a generation type down year for 2022, we didn't expect to recover those losses in 1 year. We knew it was going to be a process. We knew that it was going to take time. As a reminder, their bonds have an inverse relationship when it comes to interest rates and when it comes to prices. As interest rates rise, prices fall on all of the existing bonds that are in the marketplace. As interest rates fall, prices rise. They have an inverse relationship, which is why the Fed and their regime has been so important. When they set out to raise rates and they set out to raise them very quickly, we knew that it was going to be challenging for bonds. As rates rise, prices fall. And so when I say that we didn't expect to recover all of the drawdown in prices in 2022 in 1 year, and 2023 to have earned 13% after losing 13% in 2022, it's because we knew that it was going to take time. We knew that this was going to be a very significant regime shift that would take us a few years to recover. Where it was all worthwhile is that where rates for 10 years were 10-year bonds, government bonds, were previously 1.5% or 2%. They are now 4.5%. They are now 5%. And so we hold firm that the process of going from low rates to high rates is a painful one while it is occurring. That was the price drawdowns that we saw in 2022. But overall, for investors, having higher interest rates, you are effectively a net lender. If you are more likely to give your money to a company and have them pay you back interest, give your money to the government and have them pay you back interest, you're a net lender. Higher rates are better for investors overall. So while it takes a few years to recover from the price drawdown that we saw while rates were going from low to high, maintaining a higher level of rates is a good thing. If you are a retiree, if you're an investor, it means that you have more of an income base to earn off of those assets. Looking at exactly when I mentioned how volatile things were, at one point in time, just in the fourth quarter, we saw the 10-year Treasury yield climb by 1.7%. That was a climb of just early April to late October, a climb of more than the 10-year Treasury was paying us not 3-4 years ago to late October. Whenever, as we said, whenever rates climb, prices fall. So we did see some additional volatility through the end of October. At that point in time, we saw rates fall by a little over 1%, 100 basis points. We know that as yields fall, prices rise. So we saw a little bit of a whipsaw going into the end of the year. When all is said and done, and where that settles out, is that, even with the move lower, as we said, about 1% yields were falling into the end of the year. Current yields across the fixed income landscape still offer much better income and total return opportunities than existed a year ago, and definitely that existed 2 years ago. So what we're looking at in our slides here is all fixed income sectors. Just like it gets really easy to talk about the stock market as just the market and kind of ignore all of the components that go into it. Fixed income and bonds is very much the same, where we talk about, oh, what did bonds do? But really, there are many sectors of bonds. If we're talking about U.S. Treasuries, if we're talking about municipalities, if we're talking about investment grade corporate bonds, anything that's mortgage or asset-backed related, these tend to be more on the investment grade side. You have a line here in the middle that everything on the right-hand side is reset on a different axis for higher yields. And all of these things are a little bit more aggressive. They're a little bit more risky, but they pay us a little bit more too. But across the board, when we look at top to bottom for any of these black gray bars are 10-year ranges. The purple lines are the median yields over that same 10-year period. And then our blue diamonds are where we sit today. Almost across the board, with the exception of emerging markets, and that's more currency related than it is anything else, we are well above and beyond the averages for what our yields exist today. And so what it means is that we can stick with very vanilla core fixed income portfolios. It's investment grade, it's safe, it's not a high risk of default. We can sit in those vanilla portfolios and still earn above 5%. We can lean into riskier asset classes if the risk tolerance there, if the ability to take risk is there, like we talked about in our investment philosophy. We can lean into some of these riskier asset classes for fixed income. which still really aren't as risky or as volatile as the stock market is, but they actually pay us something. And we can see yields north of 8% in some of these riskier asset classes. So particularly when you consider all of our portfolios are broadly diversified, they're globally diversified. We like to have exposure in varying amounts to all of these fixed income sectors. Creating income today, thanks to the past couple of years and all of the interest rate increases we've seen by the Fed, generating income today is easier than it's been for quite some time. Expanding on that a little bit further, with peak interest rates likely behind us, bonds also offer the potential for price appreciation again. In the event of lower rates, then we see lower rates, we see prices increase. All the bonds that we bought today at higher rates, we get to benefit when next year, at the end of this year, sometime next year, when new bonds coming out are at a lower coupon rate, they're at a lower yield. We get the price appreciation on all the things that we bought today or that we've bought over the last year. And so what we look at on the right-hand side here, while considering all of the various sectors that we have within fixed income, and we've looked at this pretty much every quarter for the last year and a half, if not 2 years, is the impact of a 1% rise or fall in interest rates. I wouldn't say that those two scenarios are equally likely. I would say that we are more likely to see rates fall by 1% than we are to see them rise by another 1%. So it's still always possible, but I wouldn't say that those are 50-50 outcomes. But what we see here is the potential for asymmetric returns in bonds. Now that yields are higher, we have a higher base to start with. What I mean by asymmetric is that if we looked at the 10-year US Treasury here, and in the event of rates falling by 1%, we get to collect our coupons that we have right now, right about 4%. Plus, we would see price appreciation from these bonds that if rates were to fall by 1%, 10-year US Treasuries would deliver a total return of very close to 12%, because we'd see price appreciation and we'd earn some income. On the flip side, with the left side of our line here, if the interest rates rose by 1%, well, we'd still earn our 4 from an income perspective. We would see the price fall because as rates rise, prices fall. And we would look at a total return in an environment where rates rose an extra 1%. We'd lose about 4% on our 10-year US Treasuries. And so for us, these are asymmetric returns. The upside is considerably higher than the downside, even if we were to think that a 1% rise and a 1% fall were equally likely events. And this exists all across the different sectors and all across the terms. So for purposes of when we get to our impact for investors or implications for investor, this distinction is an important one for us because when we are building fixed income portfolios for clients, it at least helps us set expectations of what the near term may look like. Yes, we paid a price in 2022 for anyone who held some of these longer term bonds, but for the most part, we have a lot to look forward to in 2024 and 2025 to help us continue to get over any of the price losses that we saw in 2022. Lastly, you can't talk about rates without also talking about the Fed. What we see here is it's all a base of what the Fed funds rate is. That's the base interest rate that determines interest rates effectively across all other asset classes. So we can see that looking back the last 30 years, the ups and downs of what the Federal Reserve has done with their own rate. You can see that starting in 2021, that we into 2022 saw a considerable increase in a short amount of time. That was pretty unprecedented. In previous raises of that regard, it was 2 years or more. We saw it in just about 12 months. And so what we are also looking at is expectations for looking forward. What does the market think based off of prices today, where rates are going to go? What does the Fed think based off of the blue dots here of where they're going to put their own rate? And after hiking a cumulative 5.25% since the beginning of 2022, does seem like we're very close to being near an end. Now, as we said, the conversation becomes more, when are they going to start cutting their rates? How much are they going to cut their rates by? I do still think that it's possible we see an extended period of holding rates. A lot of times people forget that there's three possibilities when it comes to rates. It's not just raising them or decreasing them. You're allowed to just hold things constant as well. And I think we're going to see a period of that for the Fed. A lot of this just comes back to inflation. They have a 2% inflation target. We've made a lot of improvements on inflation. I've got another slide. We'll talk plenty on inflation as well. But at their most recent meeting back in December, the Fed voted to leave their Fed funds rate unchanged, and then their target rate strongly hints that rates are at their cycle, and if anything, we're going to be looking at rate cuts in the future. What's important for us, if rates fall, as we said, all of the prices of the bonds that we already own are set to increase. We know that we're buying bonds today, and we can expect to receive that income as long as we continue to hold them. An important distinction for us is the Fed and the general market participants are about 1% apart in where they think rates are going to go by the end of this year. The Fed themselves do see themselves cutting rates moderately. If we're at 5.3, 5.4 today, to see about 70, 80 basis points down to about 4.6% by the end of the year. The Fed themselves have said that is what the Fed is going to do. For whatever reason, market participants think it's going to be a whole nother percent cut from there. And what that largely means is that market participants think that the economy is going to struggle more than the Fed predicts that the economy is going to struggle. More severe cuts would be more likely if we truly hit an economic recession. The being able to manipulate interest rates, being able to cut interest rates is the primary monetary policy option that the Federal Reserve has to try and take a recession and make it a mild recession instead of an extreme recession. And so it is interesting to see that the Fed has been very clear in what they think they are going to set their own rate to by the end of the year. And market participants very much just disagree. If the economy remains afloat, still seeing minor cuts. If we hit a soft landing, still seeing minor cuts, I think is still possible. Because if we hit a soft landing, if we don't fall into a recession, it just means we got inflation under control, inflation close to 2%. If we get inflation close to 2%, the Fed is justified in decreasing their rate a little bit further. They don't want to absolutely crush economic growth. They just want to moderate it a little bit to help keep inflation in line. So overall, for us, we're being mindful of what the market and market prices think is going to happen by the end of the year and comparing that to what the Fed themselves think. Because as we mentioned previously with the earnings, whenever reality plays out different from expectations, it has the possibility for volatility. And so it's something that we're being mindful of. Either way, increasingly likely that rates will move lower in the year ahead. Exactly how much lower they move, obviously still just to be determined. We got to wait and see how things play out. Regardless, once they are lower, they're still likely going to settle at a higher level compared to what we've seen previously. I don't think that we're going to see cuts down to this range, like we saw in 2003, like we saw in 2018, anything like that. Going from the Fed, tying that into our economic update and how the last year looked for us. Not too many changes overall, to be honest, from an economic standpoint. The economy did see impressive resilience last year. First 3 quarters of the year, we're showing above trendline growth. And then the fourth quarter fell below trend line just a little bit. And easing inflation has been a big part of that. It improved prospects for growth, fueled optimism for a soft landing. And just as a reminder, a soft landing is described as the federal inflation got high. Federal Reserve did one of the only things that they're able to do. They raised interest rates. They tried to slow inflation. They succeeded in slowing inflation. And then the key component of a soft landing is that after slowing inflation, bringing it back down to normal, that the Fed is also able to maintain moderate economic growth and avoid a full-blown recession. And so it's seeming more and more likely that a soft landing is possible. Easing inflation has definitely fueled optimism for it. looking at some of the good business spending has held up. We talked about how as it pertains to AI, companies are investing in it. They're using it to get more efficient. They're using it to expand the offerings they already have. Consumers remained resilient. That we still do have a tight labor market. We won't actually talk much about labor today. We've usually talked about it in the past, but just nothing is changing. The labor market's tight, and it's going to be really hard for unemployment to increase much more than it has. We're seeing rising real wages. We have seen wage increases pretty considerably over the last 2 years. Early on, post-pandemic, it wasn't really getting consumers ahead because inflation was so high that it was, if anything, just trying to help consumers not fall as far behind on a real wage basis. But since inflation has moderated, it does appear that companies are allowing consumers to get a little further and further ahead from a real wages standpoint. Wages are increasing a little bit more than inflation is. It's not simply inflation adjustments that we're seeing for labor market participants. And then the last good thing is that the housing market appears to have stabilized. It's stabilized at slightly lower levels, but overall tight housing supply, steadying mortgage rates. It's kind of signaling that the worst is behind us. This one's easy to forget locally, and maybe you feel different if you've tried to sell your house lately or something like that. But locally, it doesn't seem that we had a considerable correction. It doesn't seem like we had even much of a noticeable correction. But historically, DFW here has been pretty insulated against housing market troubles. Nationwide, how that fits into GDP, things appear to have stabilized, albeit at lower levels. We do still have some bad components, some concerning components to GDP. There's increased caution among lenders. So with rates being higher, the possibility of a recession, all of those banks, all those financial institutions that lend money are still demonstrating some caution. It means that we're seeing a little bit less capital flow into the system for purposes of investment, for purposes of development. It could constrain growth in capital expenditures. Revolving credit as a share of disposable income, looking back at consumers, it's increased a little bit, but it's not quite to overextended levels. So, effectively credit cards and what amount of credit card debt are consumers carrying relative to their income. It's gotten a little worse compared to where it was 2 years ago, but not at a terrible clip. Delinquencies are on the rise of debts not being paid. A lot of that is occurring in the auto market. It does seem like there's been some concerns with auto loans and lower qualified borrowers and defaulting on auto loans. And is that just kind of the first stone to fall of what's going to be some kind of slippery slope or something like that? But again, it's rising, but still not quite to overextended rates. So younger households are showing signs of financial stress, but it's by no means seems to be at a breaking point yet. Labor market, we talked about that a little bit, where conditions continue to loosen, lending standards remain tight. Consumer spending should grow at a slower pace from here, while people try and make sure they stay employed and try and make sure they keep a certain amount of savings for emergencies. But overall, does seem by all indications that U.S. economy should continue to grow at a moderate but slowing pace from here. That said, tying some of our good, some of our bad into, hey, what does that mean next? It seems like in a vacuum, everything that we see today for the U.S. economy should be fine, but a slower moving economy, even if it's a growing economy, slower moving economy will be increasingly sensitive to shocks. So if the U.S. election, higher policy rates of the Fed surprising some people and continuing to raise their rates instead of hold them constant or cut them in the future. We do have geopolitical tensions in this world. War in the Middle East, Russia and Ukraine, elections in Taiwan and what it means for China and everyone's world relations. All of these are kind of exogenous shocks that, while in a vacuum and in a silo, U.S. economy is looking pretty good. There are definitely outside threats that could throw off the U.S. economy's momentum just enough that could, throw a wrench into everything and push the economy into a recession in 2024. So recession's not off the radar completely. There's outside influence that could still get us there. But when you look at just us, just the US and just our numbers, things are still looking pretty good for a soft landing. And a lot of that just has to do, here we have CPI by the various components that, that make up inflation. All of that has to do with the fact that inflation is looking pretty good after 50-year highs in 2022, where we could see that inflation peaked year over year at about a little over 9%, 9.1% in June of 22. We eased down to 3.1% year over year in November, which was the most recent data that we had as of getting all of this together, end of November prices. And so while we're still above the Fed's target, the underlying components of inflation provide us with confidence that this downtrend has room to run. We can continue in this downtrend. On the right-hand side, we're looking at services. For the most part, goods inflation has gotten under control. A lot of the goods inflation was supply chain related to the pandemic. It was, energy prices after Russia invaded Ukraine. Core goods prices have regulated quite a bit. Services are still a concern, particularly shelter, which is why on the right-hand side, we remove shelter to say like that's its own animal. Shelter cost is kind of its own thing. That does not move quickly. But even looking at services without shelter, we can see this is kind of what's remained sticky, but even services without shelter is still continuing to look good. So the last thing with shelter. Shelter is about a third of the CPI bucket. It is finally starting to turn a little bit. We're seeing some rollover in market rents. It's gradually flowing through the data. It really seems that that's kind of the last peg to fall of our inflation problem is, can we regulate shelter costs? We do structurally have a shortage of housing, particularly with affordable housing in our country. Those are not things that fix quickly, but all of that says that for the Fed and for how they monitor inflation, how they monitor prices, how they monitor the success of raising interest rates to help bring prices down, when it's looking at everything outside of housing, the Fed has realized that their actions have been persistently effective in regulating inflation. We want to be mindful of shelter. One of the last things on the right-hand side that we'd like to see a little bit of correction in is transportation services. Used car prices are still a little weird. They're still a little high, but it's more than just used car prices. It's auto insurance, it's auto repair costs. A lot of that is sticking around longer than most thought they would. But overall, we're looking good from an inflation perspective. We made impressive progress towards normal levels in 2023. Not quite back to the 2% inflation target, but we are on track, all things held constant, really about by September or so to see September of this year, to see inflation back to normal, regular levels even without a recession. So tying all of that together for what will be our 5 implications for investors, taking a look at all that data, how does that all play out for us? We will start with looking at key themes. In hindsight, we can look at any of the past couple of years, and each one tends to have a theme for what we can use to try and explain why markets are doing what they're doing, have done what they've done, everything like that. What we're looking at here is number of mentions in earnings call transcripts of Russell 3000 companies, of publicly traded companies in the US. So you can see we've got the pandemic, got supply chain, we have inflation, we have AI. In 2020, it was all about the pandemic. People were talking about the pandemic. In 2021, supply chain issues, kind of post coming out of the world reopening from the pandemic, started plaguing companies, consumers. By 2022, inflation had really taken over, and everyone was talking about inflation while supply chain was still at problematic levels. And then in 2023, it was artificial intelligence. We made a few references to it here today, but in 2023, companies were really bullish on artificial intelligence and the impact it would have on their operations. And so we can see that some of these market and economic drivers are positive, some are negative. But one thing is consistent in that they usually kind of fade away, give way to the next big thing. And so it's hard to say, well, whatever we were really talking about in this year, continuing to impact us in the next year. And that brings us to, okay, well, now that we are in January, well, what is our likely theme? What could it possibly be for 2024? And 2024 is an election year, so very possible. Every time we have an election, it's a really big part of the news cycle. Try to tie everything back, and even the financial markets, back to the election and predicting what our outcome is going to be. What we're looking at here is control of the House and Senate over the last 100 years. Republican and Democrat are mixed, and market returns. What have markets done over the last 100 years, and what kind of correlation can we try and determine from who was leading Congress? And what we see is that for 100 years, stocks trended higher, regardless of whether Democrats, Republicans, or mixed control of the House and the Senate. Stocks tend to reward disciplined investors, no matter who has the upper hand in the House and Senate. And actions by Congress may impact returns. Not even always that they do impact returns. Actions by Congress may impact returns. But other factors like geopolitical events, interest rate changes, technological advances, all of those things very much impact markets too. And in fact, they tend to impact markets considerably more than any sort of government intervention. We have a relatively recent example of that. So what we're looking at here is policy, and whether it's a candidate or president, congressional, policy by party and its impact on markets. What we're looking at here is obviously President Trump campaigned heavily to support the traditional energy industry. We've got our dotted line of change in administration. Left is Trump, right is Biden. However, during his presidency, the S&P 500 energy index, which is traditional energy, was down 40%, while the S&P 500 global clean energy index was up 275% from his inauguration through election day 2020. President Biden campaigned on scaling back fossil fuels, supporting renewables. Once he got into office, his administration passed the largest ever U.S. government commitment to climate, and that was $369 billion being allocated to climate through the Inflation Reduction Act of 2022. And given that, well, $369 billion is a lot of money. Given that, one would have expected traditional energy stocks would be punished. Renewables would be catapulted. And in fact, in both of those instances, the exact opposite has happened when we look at traditional energy sources versus global clean energy sources. Since President Biden's inauguration through the end of 2023, the S&P 500 energy index, which is traditional energy companies, oil and gas, has nearly doubled, while the S&P 500 global clean energy index was down just about 50%. It was cut in half. And the reason is that, even with government intervention, macro forces still largely drive market outcomes. Macroeconomic forces, even in the presence of substantial government intervention, macroeconomic, macro market forces still drive outcomes. When clean energy was surging during the Trump administration, there was a lot of enthusiasm around clean energy. We had ultra low interest rates that was used to finance all of this innovation. People started talking about ESG investing for the first time. So there were a lot of just other factors going in that led to a takeoff in clean energy. And then in addition, while he was president, we had a pandemic. The pandemic shocked oil prices. Oil fell to $11.50 a barrel in April 2020. Oil prices recovered while he was president, but overall, when all said and done, oil prices were kind of flat. That limited gains in the traditional energy sector. During the Biden administration, looking beyond just legislation, oil prices continued to rise steadily throughout 2021. The economy was recovering after a pandemic. We saw Russia invade Ukraine, caused oil prices to spike 33% in just a few weeks. Since then, oil prices did end 2022 pretty flat. But when all is said and done, traditional energy companies returned about 59% just due to higher profits with that, price barrel per oil increasing over time. So, higher inflation, input costs, interest rate increases, all of that has kind of staunched the rally in renewables as well. So what that tells us for implications for investors is don't allow distractions to derail you from your investment plan. Obviously, we're going to hear a lot in the news cycle about the election. There is no quantifiable evidence that it has any substantial impact on markets. Don't let the news cycle impact how we invest and how we allocate our portfolios. Don't allow those distractions to derail you from your investment plan. Looking to some of our next ones, the impact of inflation. From our economy section, we talked about that soft landing versus the hard landing will be determined by reaching inflation target. Seems like we're almost there. Anything can still happen in the next 6 to 9 months and next year. Data shows that promising news from continuing our existing trend. We also said how exogenous shocks, something outside the U.S. occurring that could cause inflation to either hold where it's at or continue to rise again, something like geopolitical events. And so for our second implication for investors, it started with inflation and it ends with inflation, in that inflation determined the initial Fed action. The Fed action was determining those interest rate increases. As interest rates increased, those determined the inputs that we use for expected returns on stocks and bonds, that higher level of interest rates. So it all started with inflation, and then when inflation returns back to normal is when Fed stopped acting and we get on with our lives. But from a soft landing versus a hard landing perspective, going back to do we get inflation under control and have a recession or not have a recession, it's important to review how your portfolio could hold up in either scenario. We don't want to try and allocate our portfolio to predict one of the two happening, but it's very possible to say, hey, as an investor and wanting to stay seated in your, during any market volatility, how are you allocated today? What's the appropriate allocation for you? And, scenario analysis, we see a recession. What does that look like? How does that translate to portfolio returns? We see a soft landing. We see slightly reduced interest rates. We do not have a recession. We allow equity markets to continue to rise. How does that look? We want to review the impact that inflation can have on your financial plan. Are you still on track to meet your goals? A lot of times the spending derails a financial plan way more than market returns do anyways. So second implication is that it started with inflation and it ends with inflation as well. Here we have what we call the periodic table of asset class returns. There are a lot of asset classes that you as investors can participate in and can invest in. From our equities section, we talked about how earnings growth estimates seem to be too optimistic. The top 10 stocks in the index versus everyone else and some of the concentration issues that we're seeing. We don't want to exclude developed internationals from our portfolios. They tell a really good value story, a really good dividend story. From our fixed income section, we talked about how almost all fixed income sectors are trading well above 10-year median yields, so they all look very attractive, and how even a vanilla core fixed income portfolio today yields above 5%. If we lean into riskier sectors or sub-asset classes, we can turn that fixed income portfolio north of 8%. All of those asset classes exist on this chart here. So for our third and fourth implications for investors are in fixed income, we want to review your allocation to terms. On average, are you in 2-year bonds, 10-year bonds, 30-year bonds, credit qualities and sectors? Are you in US government bonds or are you in high yield? All of those translate to different yield and risk characteristics as part of your portfolio. And then for equities, we want to review the allocation to high quality companies. We would define high quality companies as having strong balance sheets, ample cash balances, sustainable earnings, all of that performing well relative to the broader index. And especially if we hit a recession, the top 10 stocks in the market are 33% of the index or 20% of the earnings. We want to be mindful of what exists out there otherwise from a value perspective. And knowing overall that those internationals trade at quite a discount price-wise to the US with similar value there. Similar future earnings at much lower prices don't escape the developed international. And then our last part is focusing on opportunity cost of CDs. We've said how interest rates have changed quite a bit. It seems like interest rates have peaked. What we're looking at here is peak 6-month certificate of deposit rates during previous rate hiking cycles and what various asset classes look like in the subsequent 12 months from that peak. And so what we can see is with the gray dots reflecting the peak and then the 6-month CDs, what we earn in that time, more often than not, there's quite an opportunity cost by staying with those CDs in that after interest rates have peaked, US stocks, high yield bonds, just investment grade corporate bonds, the Bloomberg US Ag, all outperform 6-month CDs. And so cash plays a part in a portfolio, especially if you're taking distributions. We want to know that that the money is there to fulfill it. Very much short-term exists as part of a portfolio. We just don't want to chase today's highest yield and forego long-term goals and long-term returns because of that by chasing short-term needs. So what we want to do overall in our last implications for investor is it's time to put your cash to work. Be very intentional about what we have in checking, savings, money market, certificates of deposit. Be very intentional with it. Know that it's there to fulfill short-term obligations, and then really explore the rest of the fixed income landscape for everything beyond a year or two's worth of expenses, because opportunity cost exists with those short-term instruments today. And that's it for our market update. Had a rush there at the end. I ran 3 minutes long still, so I appreciate everyone who attended here today. Troy, do we get any questions in the chat?
Just one question. Was waiting for you to finish. So, looking at the chat, the only question is, where does the national debt fit in?
It's a good question. It's evident that as deficits persist and the national debt rises, that the trend that we've been on with the debt increasing is likely to persist. It has also been clear that, both political parties are willing to contribute to our national debt. Where that translates to implications for investors is that the Treasury market is gigantic. It is a large part of the U.S. Bloomberg Barclays Ag. We prefer to allocate more than the benchmark into investment grade corporate bonds if given the choice, one or the other, U.S. Treasuries versus investment grade corporates. The overall level of national debt appears from fixed income traders that manage our fixed income portfolios to have actually had little impact on the Treasury market itself, where there's no risks of considerable risks of default outside of the raising the debt ceiling limit, which most think will continue in perpetuity. Most of our fixed income traders and economists don't think that as a country we are going to decide to stop raising that debt limit. We're going to stop taking on more debt, that we're going to get our deficits under control. They think all of those are going to persist in the long run. From an implications for investor standpoint, we feel confident that it doesn't put the market for fixed income itself at risk, but it more so has potential to translate back into the growth discussion, to the inflation discussion, in terms of the debt and government spending deficits being so intertwined, of levels of deficits that we have. How does that translate to government spending? Government spending is such a large part of our GDP. Government's capacity to spend, willingness to spend, or if they start reducing the deficit, start spending less, how could that impact inflation overall if they continue spending at the levels that they have been, if not more, expanding our deficits? Is that going to impact inflation negatively? So for us, from a fixed income markets perspective, increasing the national debt doesn't concern us for, I guess, the safety of the asset class. It hasn't appeared to this point to impact trading and liquidity for those assets. If anything, it's going to be more so from gross GDP from an inflation standpoint as far as implications for investors. Great question. Anything else that's come through, Troy?
Nope, that's it. Unless anyone
Alright.
has any other questions.
As we
Not
said at the
seeing anything on
start,
my end.
any questions that you have are likely, personal and related directly to you anyways. So always feel free to give us a call, shoot us an email. We work as an ensemble here. We're all part of a big team. There's no clients that we have that only speak to me or only speak to Troy or Candace or Helen or Jim. We all work as a team here regardless. So appreciate everyone joining us today. Please let us know if you have questions. Please let us know if there's anything that we can do to help. And hope you all have a good rest of the day.
All right,
All
should be good to
right.
go.